In the spring of 2020, while the world was frozen indoors and financial markets were collapsing in real time, a decision was made that quietly reshaped the future of capitalism. There were no dramatic speeches, no public debate, no emergency vote. Instead, a line that had never been crossed before was stepped over with barely a headline. For the first time in modern history, the U.S. central bank stepped directly into the private corporate market, not by lending, not by advising, but by actively supporting companies that were on the verge of collapse. What most people never realized is that the government didn't even make those decisions itself. The power to decide which corporations survived and which were left behind was handed to a single private institution. Even more unsettling, that institution didn't ask for payment. When the most influential financial organization on the planet offers to work for free at the highest level of power, the real compensation is never money. It is access, influence, and control. What followed wasn't a temporary emergency measure. It was the acceleration of a system that had been forming for decades, one that slowly shifts ownership away from individuals and concentrates it inside institutions so large that their decisions quietly shape your housing, your job, your savings, and your future without you ever being asked. The modern financial world no longer revolves around who owns the most assets, but around who controls the systems that determine how assets are valued, traded, and protected during crisis. True power now lives in infrastructure rather than ownership. When markets panic, the institutions that understand risk best are not merely observers, they become architects of stability. Over time, governments began relying on private firms to evaluate collapsing assets, manage emergency programs, and execute interventions too complex or politically sensitive to handle internally. Each crisis strengthened that dependency. With every intervention, these firms gained deeper insight into policy decisions long before the public ever heard a word. This created a quiet feedback loop where trust turned into reliance and reliance slowly turned into dependency. Once that dependency is established, the same firm becomes the default solution for every emergency. At that point, it no longer reacts to the system. It becomes part of the system itself. Power no longer flows through elections or legislation, but through technical expertise embedded so deeply that removing it would risk collapse. That is how private institutions quietly move from participants in capitalism to architects of it. At the center of this transformation lies a simple realization that reshaped modern finance. Controlling risk means controlling behavior. Risk models do not merely measure danger, they define it. When the largest financial institutions in the world rely on the same analytical framework, their reactions become synchronized. They sell at the same time, buy at the same time, and retreat at the same time. Diversity of judgment disappears, replaced by algorithmic consensus. What looks like stability on paper often hides fragility underneath. When one dominant system becomes the lens through which trillions of dollars view the market, it doesn't just observe reality, it actively shapes it. Price movements become amplified, volatility becomes sharper, and recoveries become artificial. The illusion of safety masks a deeper vulnerability. Everyone is responding to the same signals. In moments of shock, this coordination accelerates collapse, and in moments of intervention, it accelerates recovery. Markets stop being organic and start behaving like a single machine. When a private firm controls the architecture that defines risk for banks, pension funds, insurers, and governments simultaneously, it gains influence far beyond what ownership alone could ever provide. The rise of institutional dominance did not happen through sudden conquest, but through gradual integration. Instead of competing solely on returns, certain firms positioned themselves as essential platforms within the financial ecosystem. They became unavoidable. One of the most powerful tools in this shift was the rise of passive investing. Exchange-traded funds promised simplicity, diversification, and lower costs, and for individual investors, they delivered exactly that. But what quietly changed was where control lived. Voting power did not disappear when people stopped buying individual stocks. It consolidated. When millions of investors funnel capital through the same platforms, decision-making authority flows upward to the institutions managing those platforms. Ownership looks widespread on paper, but influence becomes narrowly concentrated. Corporate boards no longer respond primarily to individual shareholders, but to a handful of massive asset managers whose votes can determine leadership, strategy, and policy direction. This transformation didn't feel hostile because it arrived disguised as efficiency. By the time its consequences became visible, the structure was already locked into place. As financial influence expanded, political influence followed naturally. In moments of economic stress, governments increasingly turned to the same institutions for guidance, valuation, and execution. These firms were asked to analyze failing banks, unwind massive asset portfolios, and manage emergency interventions that shaped entire markets. Over time, this relationship deepened. Expertise became authority. Authority became trust. Trust became influence. When the same institution advises on policy, executes market operations, and manages investment products tied to those decisions, the boundary between public interest and private advantage begins to blur. Even without intentional wrongdoing, the structural imbalance remains. Early access to information creates perfect positioning. Credibility gained in crisis becomes leverage in calm. The firm becomes indispensable not because it was chosen democratically, but because the system now depends on it. Once that dependency exists, removing it feels riskier than maintaining it, even if the long-term consequences are deeply destabilizing. One of the most visible consequences of this shift has emerged in housing. What was once a cornerstone of middle-class stability slowly transformed into a financial product. Large institutions recognized that residential homes offered predictable cash flow, long-term appreciation, and the ability to be packaged into investment vehicles. As capital flooded in, ordinary buyers found themselves competing not against neighbors, but against algorithms armed with instant financing and global capital. Entire neighborhoods were purchased not to be lived in, but to be rented indefinitely. The result was a quiet inversion of the housing market. Ownership declined while rents rose. Younger generations were not locked out because they lacked ambition, but because they were systematically outbid by institutions with unlimited scale. Even more unsettling, much of the money fueling this transformation came from retirement accounts and pensions belonging to the very people being priced out. The system fed on itself, converting personal savings into a mechanism that made personal ownership increasingly unattainable. Beyond housing, the deeper transformation unfolded inside corporate ownership itself. When the same small group of institutions holds significant stakes across entire industries, competition changes its meaning. There is little incentive to aggressively undercut prices or disrupt rivals when profits flow back to the same owners regardless of who wins. This phenomenon reshapes markets without explicit coordination. Prices rise quietly. Innovation slows subtly. Wages stagnate gradually. Industries still appear competitive, but their incentives are aligned beneath the surface. Research has repeatedly shown that markets with high levels of shared ownership exhibit worse outcomes for consumers and workers alike. Capitalism remains intact in form, but its function shifts. Instead of rewarding competition, it rewards coordination. Instead of encouraging disruption, it encourages stability at the expense of progress. Environmental and social standards added a new layer of influence to this system. On the surface, encouraging responsible corporate behavior appears unquestionably positive. However, when definitions of responsibility are set privately rather than democratically, power shifts quietly. Large institutions began tying access to capital to compliance with specific metrics, enforced through shareholder voting power. Corporations adapted quickly, but smaller businesses struggled under the weight of compliance costs. What emerged was not a level playing field, but a regulatory environment that favored scale. Standards designed by large institutions naturally benefited large institutions. Over time, these frameworks evolved from guidance into enforcement, without legislation or public oversight. Corporate priorities began shifting not in response to voters or laws, but in response to capital allocation decisions made behind closed doors. The danger of a unified financial system becomes clearest during moments of shock. When a crisis hits and most institutions rely on the same risk framework, reactions become simultaneous. Selling accelerates collapse. Buying accelerates recovery. Markets swing violently, not because of collective human judgment, but because models update at the same time. This creates instability disguised as efficiency. Even more concerning is the informational advantage embedded in such systems. Seeing market flows before execution provides insight into structural movements that others cannot access. Even without misuse, the advantage exists. History consistently shows that when structural advantages persist long enough, they eventually reshape outcomes. The issue is not intent, but inevitability. Concentrated insight produces concentrated power. As ownership consolidates, a new economic reality emerges. Access replaces ownership. Instead of owning homes, people rent them. Instead of owning companies, they hold shares without control. Instead of relying on public infrastructure, they pay recurring fees to private operators. This model is efficient for institutions because access generates predictable revenue. For individuals, it reduces independence. Wealth accumulation becomes harder as fewer assets remain available for personal ownership. History has seen similar systems before, where the majority paid for access to resources controlled by elites. The difference today lies in scale and automation. Control is no longer local or visible. It is global, algorithmic, and largely unaccountable. The final stage of this transformation targets infrastructure itself. Water systems, energy grids, transportation networks, and communication channels are increasingly treated as investment opportunities rather than public necessities. Governments, burdened by debt, trade long-term control for short-term relief. Private capital steps in, promising efficiency while securing permanent revenue streams. What was built with public money becomes a subscription service for future generations. Once essential systems are privatized, citizens no longer merely rent homes, they rent access to daily life itself. Reversing these arrangements becomes nearly impossible once contracts span decades. The system locks in dependency while presenting itself as modernization. None of this requires villains or secret plots. It is the logical outcome of incentives allowed to run unchecked. Systems naturally evolve toward efficiency, not fairness, and without public awareness, efficiency concentrates power. The first step is understanding where control actually lives. Examine how your savings are invested. Question who holds voting power over the companies you rely on. Ownership, even partial ownership, still matters. Transparency matters. Competition matters. Most of all, conversation matters. These systems thrive in silence and complexity, not because people agree with them, but because most people never see them forming. History rarely collapses in dramatic explosions. It erodes quietly, one structural shift at a time. By the time the consequences feel personal, the framework is already complete. The question is not whether this transformation is happening. It is. The question is whether enough people recognize it early enough to demand a different future. One where ownership, accountability, and opportunity remain possible rather than permanently rented.